Natural gas.
Natural gas, bullish.
Crude oil.
Neutral.
Gasoline.
Neutral.
Gold.
Bearish.
Silver.
Bearish.
Platinum.
Bearish.
Copper.
Bearish.
Palladium.
Bearish.
Soybeans.
Soybeans also bearish.
Soybean oil.
Bearish.
Soybean meal.
Bearish.
Wheat.
Neutral.
Oats.
Bearish.
Coffee.
Bullish.
Orange juice.
Bearish.
Cocoa.
Bearish.
Sugar.
Bearish.
Cotton.
Bearish.
Bitcoin.
Bullish.
We are in the midst of a huge commodity bull market. Oil and natural gas are off the charts. Industrial metals are going wild. Precious metals, even soft commodities are breathing some pretty rarefied air. So I wanted to speak to someone who's following these commodity markets extremely closely, someone with a dispassionate view. Here at Forward Guidance, we've had on very senior investors who have seen half a century of price action, if you will. Felix Zulauf. We've had legendary investors. But here at Forward Guidance, we're not just about the past, previous financial. We're trying to find the bright financial minds of the future. And the audience, has been very generous in that you haven't held my young age against me. So I hope you will extend the same courtesy to my next guest, Lukas Kuemmerle, author of the Commodity Report. Lukas, welcome to Forward Guidance.
Jack, thank you very much for having me on the show. It's a huge pleasure for me. Thanks.
Lukas, you are someone who, within a minute of reading your work, your love, your passion, your fascination with the commodity complex is evident. How did you get this love for commodities, and how did you develop as a commodity analyst?
Well, thanks for the introduction at first. I guess that's just something that not many people do over here in Germany, where I'm based. In Germany, mainly people talking about stocks, ETFs, but other things that are not so much known, like, for example, commodity trading in forms of futures trading and investing and research in that space. It's just something that wasn't really known over here. And I just wanted to do something different back then. Well, if I look back, I started with reading and making analyses in this space about 4 years ago. And I'm still learning till today. And it's just something that I really love doing. And where I think I really have found a niche, especially over here in Germany, where, as I said before, commodity research is not so much known.
And Lukas, your research, part of it is fundamental, but the bulk of it is quantitative and technical, looking at back tests, looking at the last time that this spread was in an inversion, 70% of the time oil was up over the next 3 months, stuff like that. Stuff that is actually it's much better at predicting price movements than explaining why. It's not friendly to narratives, which is why I want to get into it. So why are you what drew you to that style of analysis rather than someone who's saying, I'm looking at the pipelines, I'm looking at the what's going on the ground?
Exactly, Jack. I'm a big friend and a believer that we can learn lots from the history. And this is also the approach that I'm going with in my investing philosophy. So what I'm basically doing is I'm looking, of course, at fundamentals. So what have we on the supply side, on the demand side, and as well, what have we for storage data and things that are just important in this space. But as you pointed out, I'm looking very much at the technical analysis, which is not only looking at the chart and look when there is a movement or a breakout. For me, technical analysis is more about positioning data, to look at the CFTC futures data, to look at the term structure of futures contracts, and to look at seasonals or at cycles that repeat over and over in the market, and where I'm able to detect some patterns that I can use for me to perform trades in the market. this is kind of the approach that I'm doing, and that I'm doing successfully till today.
Lukas, I'm gonna ask you. Let's play a little bit of a game. I'm gonna name some commodities, and you'll say whether you're bullish, bearish, or neutral on, let's say, a 3-month time horizon. How's that sound?
Okay, Jay, let's do this game.
Okay. Crude oil.
Yeah, crude oil is a neutral for me, but slightly bullish.
Natural gas.
Natural gas, as you can see also today with a big spike on the charts, is very bullish for me right now.
Yes, I should say we're filming on Tuesday, April 5th. Live cattle.
Live cattle, also a very bullish market for me, where we get into bullish seasonalities very soon. So have that also on my watch list.
All right. Gold and silver.
Gold and silver are kind of a neutral, but slightly bearish for me, especially when we have a high correlation at gold with the real yields. Of course, precious metals currently get kind of a premium because of the war that's going on in the Ukraine. Silver, on the other hand, is slightly more industrial driven precious metal, where we have to look how the economy is evolving over the next few months. If we see there that the recession becomes more and more likely, and we saw lots of evidence in the past 2 weeks of that, silver could also have a tough time over the next month. So, as I said before, slightly bearish towards both of them.
Platinum and palladium.
Platinum and palladium are, for me, I see their use case more in the industrial area as well. Platinum and palladium are predestinated for building catalysts in the automotive industry. And therefore, I'm still slightly bearish towards them. But and there's one point we have to really point out here, is that Russia is the main supplier to the world. They account for about 40% of total palladium. So, of course, this metal is highly news-driven right now.
Soybeans.
Soybeans, actually really new, but a bearish thesis here, because we saw last week a news release from the USDA pointing out that farmers switching actually from planting more corn rather than soybeans, simply because of the fact that they have much less of a fertilizer exposure. So you need more fertilizers to plant corn than to plant soybeans. And this will, of course, lead to a higher yield of soybeans in the future. And therefore, I think that soybeans is slightly bearish right now. And on the other hand, corn is slightly more bullish right now.
Soybean is slightly bearish, and we'll get into your thinking there about the fertilizer and the planting seasons, the acreage. Fascinating that I learned that from reading your work. So you're slightly bearish on soybeans, but is there another soybean related product that you're more bearish on?
Actually, if you talk about soybeans, which is the main product, you also have to talk about soybean oil and soybean meal. So basically, if you crush a single soybean, you get some amount of soybean oil, and the other amount is crush, which gets transformed into meal, soybean meal. And for me, actually, soybean meal looks the most bearish right now. And this is also a trade I'm currently performing, to the downside.
So yes, you're a short soybean meal. We'll get into that. Anything in the world of the softs, coffee, orange juice, cocoa, sugar, cotton, that you have a view on?
Yeah, softs is also a very fascinating sector, because almost every soft commodity has its own story. If you can, for example, compare the market dynamics of the coffee market with the market dynamics of the cocoa market or the sugar market. So very fascinating market, very diversified market. I'm currently very bullish on coffee as well. But the rest of the commodities, for example, orange juice futures, something that I'm more bearish towards. We also have to point out that soft commodities are more the luxury type of commodities. So they also have to do with economic momentum. Our economy is more expanding? Are people in other countries able to afford these luxury commodities?
Bitcoin
is actually also bullish for me right now, which actually sounds crazy to me because the underlying fundamental situation looks more like that we have a risk of, that we see draining liquidity, less liquidity in the market, which actually should weaken the price of risk assets if you put Bitcoin into a basket of risk assets. But Bitcoin is still surprisingly stable at the current levels. And so for now, Bitcoin is still bullish for me.
Lukas, we've got a chart that you made of the year-to-date performance of the commodities, and it is very striking. The clear leader has been the energy complex. What are you seeing there? Why are you more bullish on natural gas as opposed to oil? And then how does Russia's invasion of Ukraine factor into all that?
Of course, as we can clearly see, energy was the best performing sector year to date, but closely followed by the grain sector. Energy is still quite bullish, explicit to say it, natural gas, because my pattern is confirmed there. I see strong market fundamentals there right now. I see a huge demand for natural gas. We see especially the Russian crisis, which affects the price of this commodity a lot. If you look to Europe, where I'm based, we have big troubles to keep up with the demand, because we would like to put some kind of embargo over Russian imports of natural gas, of oil, and also of coal. We have to figure out how to keep demand meet. But as a good gets less and less available on the market, this automatically pushes up the price of a commodity. That's basic economics, and it's actually what we're seeing right now, natural gas. In terms why I'm more bullish on natural gas right now than on crude oil, it's just that we in a relative more stronger upward seasonality in natural gas than we are in crude oil. Moreover, the positioning data which I'm looking at is quite bullish. The sentiment around natural gas is also not quite as crowded as it is, for example, at crude oil right now. So basically, to say it in simple words, both energy sources right now are still attractive, but over the short term, so let's say 3 months, I still believe that we have better opportunities in natural gas market than in the crude oil market.
So when you say seasonality, I've heard of that before. In the spring to summer period is pretty bearish for oil on average over the past 30 years. Then there's something called the turnaround season, which is when it starts to get cold. But what does that actually mean? You've got a lot of charts on the seasonality. Let's just take a look at the one for natural gas, for example. What are we seeing here, and why does that how does that shape your bullish view on natural gas, and how does the seasonality of oil shape that too?
If we look at the seasonality of natural gas, we seen clearly that we last week entered the build-up phase of the year, which lasts 6 months in general. This is a time where inventories in the US get built up again, so natural gas has to be bought, and inventories have to get filled up again. Also, if you a consumer, you buy natural gas in times when it's getting warmer, and you fill up your tank in times when you don't have to heat. So that's just basic knowledge. And this represents...
As a consumer, you use more natural gas when it's getting warmer?
No, what you do as a consumer is you refill the tanks when it gets warmer, because you need the storage, the natural gas, when it gets cold again. So yeah, you basically buy natural gas back in spring and summer because you need it in autumn and winter.
Does that make a lot of sense? Like, I feel like if there's a, when it's hot, you think that, people talk about, the cold winter. Europe's going to have a cold winter. You need all this natural gas. Isn't it winter when the real price spikes are likely?
The price spikes are actually, if you look at the past, more likely in periods of the build-up phase, which is from now on over the next 6 months. Why this is, what the fundamental driver behind this is, I really can't tell you, Jack. But I know from a statistical point of view that it's just important and that it works. And this is also something in my thinking process. If I see something that really has an importance and that worked over many, many years, then it's something I really want to include into my analysis. And this is, for example, here also in the seasonality data of natural gas. And the same is partially true for crude oil. Basic thinking here again. Inventories get filled up when not too much crude oil is needed right now, because we get now again back into spring and summer. Temperatures get warmer. Households need less oil to heat. And this is the time when you want to refill your tanks. So yeah, this is why the seasonality is looking like it looks like.
Okay, we got the buildup of the tanks, and we can actually look at this chart of the stocks of U.S. crude oil that's in black versus the price of crude oil in green. And we'll see, during 2020, there was a huge buildup in stocks because demand for oil just fell off a cliff. But now the stocks of oil are just so low. They're almost, they're flirting with the lows that it made in 2018. So it's like it's almost making a 4-year low. How should we be thinking about that? Because when I think, the inventories are so low, there's no oil. But then also you're telling me once the stocks are building back up, that is extremely bullish. So the fact that inventories are so low, I've seen people who I respect a lot, people who I've interviewed, like Tracy Schuchart, talk about how low inventories is a bullish sign. Does your analysis corroborate that? And how should we be thinking if the stocks are about to surge back up?
Great point, Jack, and also a concerning point. Last week, Biden announced that he will release some reserves from the Strategic Reserve, SPR. I guess it was about 1 million barrels per day over a time frame of 6 months, which is quite bearish in the short term for the forward futures contracts, which are due in a couple of months. I guess this was also the reason why we saw to some extent a decline in crude oil prices in the last week. But if you think about it, it's also quite bullish for contracts that are further in the future. Because if you release now oil from the SPR reserves, these reserves somehow have to get restocked again sometimes. And I can tell you there's a really high probability that the US has to pay a higher price for oil to refill these stocks in the future. I guess the next 4 to 6 months will really show us what we can expect from the future, because it's not only the US, it's also Europe. We really have to restock our inventories before the next autumn and winter comes, when we will be again reliant on these inventories to heat our homes, basically. And basically, if we look at the US government, there are also some options they have to build up these inventories. I mean, the simplest one would be to just increase production again. But it currently looks like that's not happening because there are structural issues in the oil industry where we saw that just these low capex sector involved because all of the ESG hype that built up over many years and basically resulted into declining cash flows into the sector. Moreover, companies in the oil sector use then those profits they generated to increase the shareholder value in terms of repaying debt, making stock buybacks, or paying out higher dividends. So we have a problem here that we can't pick up the production in the US to the extent that we really need it right now. Another way or another option for the US government to increase inventories again would be to get some better signs from the OPEC, because over the last couple of months they weren't even able to really meet their production goals. That changed in the last month, so they were able to meet those goals again and meet the production promises they made, which is basically a good sign. But we do not have. We can't forget that the OPEC is an ally of Russia. They're working very close together in terms of OPEC plus. And I guess here the OPEC really would not like to be to any extent political. And therefore I really don't expect that OPEC will increase the production significantly from here on, even if they would be able to do it. Just to not upset Russia, basically. Another option I see to increase these inventories again is getting a deal done with Iran in terms of a nuclear deal. This could supply as many as 750,000 barrels of oil, more than currently. But yeah, as you can see, there are a few options that we have, but all of them are highly political driven, and I'm really not able to make a comment on how probable each of these options is right now.
So you're cautiously bullish on oil, but you don't have a position. But it's my understanding that you actually do have a position in natural gas. How are you trading that? What sort of contracts? And also, do you have a particular price target? Do you have a stop loss? How are you thinking about risk? And are you bullish or are you very bullish?
That's a very good point. I mean, this is also something really more people have to speak about, is basically risk management. So basically you can be 60% of the times wrong, but you can still be a good investor or a good trader if your profits are larger than your losses, which sounds simple, but it isn't. I do think that natural gas will go further up from here. A specific price target I haven't got. What I'm using from here on is a trailing stop loss. So I'm a trend trader. I try to stay as long in the trade as I can, and I try to ride the wave as high as I can. And if the trend changes and I get stopped out, then I get stopped out. But this is kind of my philosophy behind the trades I'm performing.
Lukas, what was your view coming into the year on the price of commodities? Were you a commodity bear, a commodity bull? And how did Russia's invasion of Ukraine and the responding explosion in the price of commodities, how did that change your view?
Yeah. So no one really saw that coming, that Russia will invade the Ukraine at the beginning of the year. So I guess this also catch many investors on the wrong foot. In terms of supply chain issues, which is a big topic in the commodity sector, because many prices are also driven by supply chain factors, for example, trucking or shipping. We actually saw easing signs So the congestion was getting less at the ports. Freight rates came down a little bit to a certain extent, as did trucking rates. And we also saw a topping out process in the PPI, Producer Price Index, which was an encouraging sign. My belief was that inflation is actually topping out as well, because it was basically just hard to beat the year-on-year comparisons, which is how inflation is basically measured. But yeah, the invasion from Russia and to the Ukraine was just a game changer, because both countries are just really important players in the commodity sector, both in the energy sector but also in the grain sector. And this, in my opinion, extended the current commodity bull market over an unknown time. So basically, what I'm saying also is that if we see signs of a peace agreement, or that things will get better on behalf of this dispute, that commodity prices will weaken again. But it's just so hard to forecast these political driven things.
So, Lukas, you changed your midterm view, let's call it, because of the invasion of Ukraine. You were bearish on the commodity complex to cautiously bullish. But the first time that we spoke, Lukas, I believe it was March 10th. And that was either 2 days before or 2 days after the absolute peak, when WTI crude was at like $120, the US oil fund was at $86. It was crazy. And at that time, Lukas, you were extremely bearish, which you and I have opposite styles, and your style is much better, to be clear. But I'm someone who, because I'm a journalist, I talk to a lot of people, I can get kind of worked up. I'm like, there's a shortage. Oh my God, blah, blah. And you were much more calm and collected. And I asked you, I pretty much named every commodity. I was like, cotton, and you were like, bearish. Natural gas, bearish. Oil, bearish. And the reasons I didn't really get at the time, but they had to do with the certain spreads and particularly the shape of the forward curve. Can you explain why? What did you see in the forward curve of oil and natural gas that made you so bearish about a month ago? And why are you cautiously bullish now? What's changed?
Yeah, Jack, I think you give me way too much credit here. Basically, what I saw was just human nature and human psychology. We saw maximum fear in the market. The sentiment in these markets was way over the top.
Sorry. Just to be clear, for an equity world, maximum fear means everyone's bearish. But in commodities, maximum fear can mean everyone's bullish because they think the world's going to end and there's going to be no oil. So maximum fear in terms of price going up. Sorry, go ahead.
Yeah, right. That's important to know for listeners. You talked about the forward curve. It's also important theme if you're a futures trader. What is backwardation? Backwardation is basically if the futures contract that you have right now is the highest in price value, and the futures contract that comes next is cheaper than the current run. So basically it means there are so many buyers in the market that want the nearest delivery possible. So they're able to pay a higher premium on the forward contract just to get earlier delivery on the commodity. And if something like this appears in the forward curve, it's called a backwardation. If the forward curve is normal, as we call it, then it's in a contango. That means as longer as the next futures contract is in the future, the pricier it gets. But what we currently see is in so many commodity markets, basically the whole energy sector, the whole grain sector, and parts of the soft commodity sector is there are solely backwardations because demand is really so high. And there are different ways to measure the extent of backwardation. What I'm using therefore is I look at time spreads. between futures contracts. What I'm using is looking at the first and the second futures contract. But I'm also looking at the current futures contract and the one year in the future, which is basically a 1 year time spread. And what I was observing back then when we spoke first was that the spreads were at levels that usually lead to actually a decline in commodity prices, because you can very good see if the premium on certain contracts is too high, that speaks actually for too much pessimism in the market. And too many buyers in the market. And this was actually really what happened back then, because commodity prices were at this moment declining again.
Right. Just to zoom out a bit. So for people who don't know what backwardation or contango is, just look up the price of oil, WTI, and on CME, let's say, and you'll see the current contract, May 2022, 110. I'm just making these numbers up. Then June, 107. Then July, 103. And it's downward sloping curve. So that is backwardation, which is not normal. Normal is contango. And Lukas, I heard from the commodity traders I've spoken to that backwardation is bullish. But it's my understanding from you that, yes, backwardation is bullish, but extreme backwardation, like the type that we can see in this chart for 1 month spread of natural gas, can actually be bearish. In particular, the spread with the 1 month between the front month, which in this case would be May, and the June, which would be the second month.
Yeah, I think that's also a topic we should elaborate on, because there are many commodity funds out there and also commodity ETFs which have a particular great performance over the last 2 years. But here it's really important to look at these ETFs and funds and look what is actually in them. And most of the times, those ETFs are futures backed. So basically, the ETF is buying futures contracts, and this is what you get as an ETF. It's basically replicated. This works very, very good as a passive investment strategy, as long as many commodities are in the backwardation. Because if you are a futures trader and you have contracts, you are forced to roll these contracts into a next month. And if you, in a backwardation, like many commodities are right now, you actually make a rolling win. So you make a little bit of money if you roll the contract into the next month. And this is particular also a big reason why commodity funds in this environment performing pretty good. But it should also be a warning sign to investors that things can change here real fast if these backwardations switch back again into a contango.
Yes, and I think things are maybe in a mild contango for the front month, but in the 1 year spread, so that which we can put up here, that would be May 22 minus May 2023, still in backwardation. So tell us what we're seeing here. I think in the red line is the price of natural gas, and then the blue, the candlestick, is the spread.
Right. Basically, what I'm doing with these charts is confirming breakouts. So if I see that a commodity, like for example natural gas, as we have here, is breaking up to the upside, I would like to confirm this breakout with the term structure. So what I'm looking is I'm looking if the 1 year spread is also breaking out to the upside. If that's the case, this is confirming to me the bullish bias. And it's basically another part of my my analysis, my research that I'm doing to confirm trade. We also spoke earlier about risk management, which we should always tell listeners is place a stop. If an idea isn't working out as you expected, you always need to have a stop to protect your money. Everything I do is very much statistical driven, and it's all about probabilities, but you have to play after your own rules to keep the money management going.
I believe you use that same technique on soybean meal. If you look at this chart in the blue line, it's the price of soybean meal. The candlestick black and blue is the time spread, the 1 year time spread for soybean meal. So the fact that the spread has been going down means it's still in backwardation, as you say, but it's not going. It's less in backwardation. It's going less into backwardation, and that for you is your signal, right?
Yeah, exactly.
So Lucas, that is the technical reason for your short on soybean meal, but you also have a fundamental reason that involves the huge surge in the price of fertilizers and how that impacts farmers' decisions on which crops to plant. So what is your fundamental reason on your soybean meal short?
Yes, as we discussed earlier, the USDA last week released the planting process report for US farmers. And the main change from last year that we saw there was that farmers actually forecasting to plant much more soybeans than they will plant corn. So basically what we will see if this plays out like it should is that we will have much more soybeans at the end of next year than we will have corn. So from this standpoint, fundamental standpoint, this is actually bullish for corn prices and bearish for soybean prices. Now, of course, the next question that you probably have is why is this the case? So why do farmers do that? And this is just because fertilizer prices were also going exponential over the last years. And now together with sanctions on Russia, fertilizer prices were going up even more, especially granular fertilizers, which are based on natural gas. So there you have the connection again. Russia is the main exporter of natural gas, and you have nitrogen-based fertilizers, which are in the processing step made out of natural gas. There's the connection again. And if we now look at how much percentage of the operating costs need both grains, we just have to say that soybeans need around 18% of the operating costs come here from fertilizers, while if you look at corn prices, you have as much as 37%. So there's a huge difference. And if you're a farmer and you have to decide which one makes more sense to plant in terms of making money at the end of a year, and you see that fertilizer prices are going higher, then I think what happened here is just farmers realized it makes, from an economic standpoint, more sense to plant soybeans because I will need less fertilizers than planting corn. So yeah, this is my thesis why we actually saw these changes in these reports and why I'm bearish on soybeans.
So it's kind of like if the price of water went up 50 times, farmers would plant, fewer roses and more cactuses.
Yeah, that's a good example, Jack. What I should also point out that in the future space, there are many ways to play those trades. I, for example, decided to go and short solely the soybean meal contract. You could, on the other hand, also say I just perform a spread trade, which would basically be the analogy of saying I bet on higher corn prices, so I go long corn. And I also think that soybean prices will decline in value, so I go a long corn, short soybean trade, and you just bet on the spread. This would be another way to perform such a trade if you have the same thesis like I have here. As you can see, there are very much variations that you can play around in the futures world.
And Lucas, what about wheat? Again, I'm living in the media. I see oh my God, Ukraine and Russia, they produce all of this wheat. Egypt is, the price of wheat is going to go up so many times. And coincidentally, you had the price of like wheat ETFs and front month futures surge, but now they've come down. And the question is that due to speculation? What's going on with the fundamentals? Most of the wheat that Russia and Ukraine produces, it actually consumes itself. It doesn't export. So what's your outlook on the wheat complex, and has the bullishness gotten a little bit ahead of itself?
Yeah, this was also my thesis back when we spoke last time, when we actually saw the peak in wheat prices. For now, no one knows if we see higher highs. I, from my standpoint, I do not think that we see higher highs on wheat prices. What I think happened there was that the market tried to price in that the whole crop from Russia and from Ukraine will be gone for the next year. And I think this reflected the price surge back then. But I think the market became a little bit more confident that this view was probably too extreme. And therefore prices from wheat crashed back down and are still, and I think we have to point this out again, are still on very elevated levels. But yeah, as I said before, I don't think that we will go much higher here in terms of wheat prices.
Lukas, what role does shipping play in all of this? You've got some great charts showing the huge surge in the different indices, the China Freight Index, the Harpex Index, the Drewry World Container Index. Some of them have gone down a little bit, but some of them continue to rise. What does this indicate, and how does it affect the price of the commodities themselves?
Yeah, a very important topic when it comes to commodities. And here it's also important to differentiate between container shipping and dry bulk shipping. We have many commodities that are shipped by container, like, for example, frozen orange concentrate, like, for example, cocoa, coffee beans. But we also have components that are shipped with dry bulk bulkers, like, for example, many grains, or almost all of them. And therefore, there are different ways to measure the cost of shipping these things. And what we can basically see is that the price of dry bulk shipping has come down a lot from its actual peak, but is still on elevated levels. So this is also kind of a supporting factor here when it comes to these commodity prices. The actual transport and shipping of this commodity is still very, very pricey, much pricier than it was years before. And if you also look at these indices from container shipping, this is also true there, but container shipping is a little bit more extreme because we still at the highs. It seems to me like container rates are trying to roll over to the downside again. But we can't forget at which extreme levels we are still here on the cost of shipping goods. A big factor also here are the renewed corona restrictions in China, which could, to some extent, at least for now, cool down the shipping rate market a little bit, because production is, to a certain extent, over there in China halted because of COVID restrictions, which could ease the market for now. And if you look at the container rates, this looks to me like this is also the case. But I really have to monitor this closely over a longer term basis. For now, I think rates are really rolling over to the downside. Also, if you keep in mind that the economic slowdown will play its role in this environment. So this could be another main factor that brings down container rates as well. slowing demand from the consumer for goods, but a pickup for demand in services would be another point that would sustain this weakness in container rates.
And in particular, you made a note that the shipping rates affect the commodities, the soft commodities. What did he mean by that? What commodities are we talking about, and is it up or down?
Yeah, so basically we have a high correlation between shipping rates and, or I must say, between container shipping rates and the price of soft commodities. As I said before, this is mainly the reason that most, if not all, soft commodities are transported by container ships, while, for example, crude oil or natural gas are transported by tanker, grains are transported by dry bulk shippers. And this is the reason why there is such a high correlation between container freight rates and the price of soft commodities. So basically, you can say if we see weakness in container rates, this would for me also indicate that we do for a reversal in soft commodity prices, namely here cotton, sugar, some that I'm more bearish towards, or cocoa. So this is definitely a correlation to keep in mind: shipping rates and soft commodities.
You said copper?
Cotton.
Oh, sorry, I missed her. Okay. Well, I just my mind wanted to go to copper, Lucas, because I know you are quite bearish on copper, industrial commodity used in a lot of traditional manufacturing, but also building the economy of the future, electric vehicles, all these motors. We're gonna have a lot of copper, right? Why are you bearish on copper at this particular junction?
Here in the medium term, I'm bearish copper because of mainly two factors. The first one is that I believe in a slowing economic momentum, and we saw more evidence of that with the inverting yield curve, which usually leads to a recession over the next 11-12 months, something like that. Which would, of course, slow the down the demand for copper as well. This is the one factor that I see, so economic slowdown. On the other hand, there is an interesting correlation between copper inventories and the copper price itself. So we actually see right now, if you look at the LME copper inventories, that they are very much down over the last, I guess 1 year. It seems to me like there is already a bottoming process forming. But nevertheless, the fact is that inventories are very much down. The important aspect here is that the correlation says that if these copper inventories get refilled again or restacked, that the actual copper price tends to move at least sideways, but more than often declines in price. So another technical observation I made here, which could be quite important in the future. And those are the two factors why I see a bearish case for copper, at least in the midterm. As you pointed out, the actual demand for copper over the long term is huge, and if we can actually meet the current demand to build the economy and the world of the future, it's a whole another question, which I doubt as well. So please keep in mind that this is a medium forecast from me, not a long term.
Lucas, typically huge surge in the price of commodities coincides with dollar weakness. This situation we've seen over the past 4 months, a little bit rare in that commodities have lost their minds. They're off the charts, but the dollar too has risen, appreciated against pretty much every other currency, maybe with the exception of the Brazilian real. How do you explain that phenomenon? And how are you thinking about the negative, now positive correlation between commodities and the dollar?
Yeah, that's another aspect that makes the current commodity bull market so unique. Basically, in the past, you you could have said if commodities going higher, the dollar is currently in a weaker spot. But you can't do this anymore because the correlation is actually broken over the last year. So tough spot here. You spoke about the Brazilian real. This is also an observation I made is if you look at the year-to-date performance of currencies against the US dollar, you can actually see that those commodities that have high exposure towards commodities, like, for example, Brazil, Australia, or even New Zealand and Canada, those currencies performing much better against the US dollar. And I think you can solely explain this with the reason that commodity prices are doing so well, which is benefiting the economies over there.
Lukas, you're in Germany. Germany's kind of the hotspot right now for vulnerability to commodity price surges because so much of Germany's natural gas comes from Russia. What are you seeing on the ground? I mean, are people driving less? How much has the euro per liter gone up? And is it depressing demand? And do you think it's realistic for Europe to cut off oil, natural gas, or even, as was proposed today on April 5th, coal from Russia?
Yeah, first of all, I think it's very depressing to see those price surges, but especially for households and people in society that have the least. They have to turn around every euro to basically keep things going. It's a tough spot. It's much more pricier to refill your car. It's much more pricier to use energy. If you, for example, look at heating, many households over here in Germany heat with gas as well. We saw that year to date, the prices of natural gas for consumers rose more than 75%, which is insane because we're just in April. We really feel the consequences that especially these Russian sanctions have. In the media, we actually also today saw renewed changes to put more restrictions on Russia and to ban even oil, coal, and natural gas imports towards Europe. I can understand the thinking and I kind of support it, but we also have to be realistic here and look how dependent Germany actually still is on Russian energy imports. And if you are realistic, you just can't cut off all the energy imports you currently have from Russia from one day to another. So this is a step you can make, but over a prolonged time frame.
Why not, Lukas? Why can't Germany cut itself off from Russian oil, natural gas? How high would the price of oil and natural gas go? And are your back tests that you've done over the past 10, 20, 30, 40, maybe 50 years, do they no longer apply in a world where Russian gas is no longer flowing?
Yeah, first of all, Jack, I really can't answer the question of how high the prices would go if we really cut off all energy exposure we have to Russia. But what we actually have to talk about is what kind of solutions are here, or which partners can Germany find to cut exposure from Russia and to put it, for example, to Saudi Arabia, which also have large gas flows. But we know from the past how long it usually takes to get those contracts done, and I just don't think that Germany is able to get these deals done in a couple of days. I think that's a process that lasts at least months. I hope not years, but I think we also come back here to the same problem we have in the US. We need to use the time that we have now from spring to autumn to make new deals with our allies, with Western countries. We really have to use this time and get some deals done to change our exposure here away from Russia, and search other partners in this area. And Germany is also very reliant on its chemical industry. And if you would just, for example, you cut Russian gas flows from today to tomorrow, this would have also high implications, many jobless people there. This would also cause some dramatic changes in the society. I just don't think that it's a realistic standpoint to cut this exposure from one day to another. Just put it that way. Yeah.
Very interesting. Lukas, to switch topics entirely, I've got to ask you about one of the other commodities, if we can call it, that you are constructive on, bullish on, and that is Bitcoin. What's your thinking here?
Yeah, I guess as you pointed out at the beginning, we're still quite young, and this makes it easier for us to grab the technology that actually is behind the whole cryptocurrency sector. I'm also a believer in long-term crypto currencies like Bitcoin, Ethereum, and but less on those stable coins that I built on the actual technology. What I can't really do is take my analysis process and put it one-on-one from a commodity like coffee to Bitcoin, because there are very much different market drivers that are in place there. Nevertheless, I still see Bitcoin as a commodity because of its scarcity. We know that there will be mined a maximum of 21 million Bitcoins, and this makes the asset scarer. And it's also the reason for me to put the commodity Bitcoin to the commodity gold because of its scarcity. For me, I know many people don't like to hear this, but for me, Bitcoin is still something like the digital gold for also younger generations. And yeah, so generally I would say that I'm a big friend of cryptocurrencies, but every asset class has its own time, and the art is here to find the right timing to be in it and know when it makes more sense to be out of it.
Well, Lukas, it's been great having you on Forward Guidance, hearing your framework, hearing your views on commodities. Where can people find your work? What's your Twitter? And tell them about the report that you do.
Yeah, thanks, Jack, for giving me the opportunity. It was a pleasure to be on the show. People can look me up on a Twitter name at Lukas Kuemmerle. You can also Google the Kuemmerle report, which is the report I write for institutional but also private investors, which just want to get to know the commodity sector better, to see what the latest trends are and where the latest opportunities are. So you can look this up, and so you have a Substack.
So the commodity report, I think, is your free one, and the Kuemmerle report, your last name, is the paid one. I got to see your paid work, and both of them are great, but the paid one is better, I have to say. Way more in depth.
Yeah, thanks, Jack. I really appreciate that.
All right. Well, Lukas, thanks so much.
Thank you. Bye.